Hi, everyone, and welcome, Miguel. Welcome to this episode. It's a very big pleasure to have you here. How are you today?
Thank you, Michele. My pleasure. It's a very nice, very cold morning in New York City, which sometimes those are the most productive days. So I'm excited to be talking to you.
Great. Lucky for me, in Italy, it's very sunny today, so it's a better weather, to be honest. But I would love to get to know you a little bit more. I follow you on LinkedIn, of course, and I saw all the kind of very great content that you're posting. But I would love to have your, let's say, introduction of Gilgamesh Venture and what are you doing in the industry right now.
Yeah, absolutely. So I just to back up a little bit, I started my career in New York City in the banking world.
Mhm.
Both I was at Citigroup and then Bank of Tokyo Mitsubishi for close to a decade. And a couple of those years, especially at Citigroup, I rotated and I spent 2 years in operations and technology.
Mhm.
And Michele, a lot of people talk about this, how banks are still using old technology. I saw it with my own eyes. I worked with those platforms and it was truly terrible, right? And this was 10 years ago, still hasn't changed much. That's the reality. And so that started my journey of paying attention to who was modernizing this industry, right? One of my good friends went on to start a company similar to your story. And so I angel invested. That was almost 10 years ago as well. And from then on, I started kind of making small angel checks. Very few, not a big portfolio, very few, but at least I was in, right? And at least I was learning how this world works. I was learning who are some of the players, and at least as an outsider, what does it take, right? Learn a little bit about the founder journey. And so fast forward a little bit, my co-founder and I saw an opportunity to raise some capital and continue making these angel investments that we're already doing. And so we raised our first fund about three to 4 years ago. We started with a $10 million fund, always focused on fintech. Even my angel investments were always focused on fintech. And so it was about doubling down on what we understood and what we knew and strengthening, right? Compounding where we had an edge, and that's not just an edge in knowledge, but also in our personal networks and in everything that involves kind of finding opportunities in fintech. So it's been close to 5 years at this point. We have so far backed 40 companies across. We started with the Americas, but increasingly we have companies that are global. We have companies that are operating in Southeast Asia. We even have a company that has customers in Africa. So it's increasingly a global portfolio. We're managing about 35 million assets under management and growing. And we have never been more sure and excited about the fintech opportunity. Most of what we do ends up being B2B. Number one, it's a little bit of our bias and interest, but number two is number one is our bias, but number two, it's following the founders, right? I think about 20% of our founders are building for consumer opportunities, whether it is direct to consumer or B2B2C, but 80% is just B2B. So that's where we see a lot of opportunity as well, globally.
There was a huge shift in the market, in my opinion, under that point of view. So up until I would say 2018 or 2020, 80% of the opportunities were in the B2C market, in my opinion. Then after the downturn that we saw in the market, 2021, 2022, startups realized that they needed more stability under that point of view, and there was a huge shift to B2B B2B companies, in my opinion. I'm not sure if you saw the same on your
I
side, or if it's more, an opportunity based.
it's a little bit of what you're saying, but I would say the shift happened a little bit sooner than that, even before 22. Um, and it depends on the market, right? At least thinking about the US market, for example, and this happens in most markets. The initial opportunities in fintech are consumer focused, right? Look at Chime, look at look at Klarna, look at Affirm, and the list is extremely long, right? Parallel to that, kind of the first B2B opportunity tends to be payments, right? And we have a lot of examples. I mean, look at Stripe. But once consumer fintech is played out and starts getting saturated, right, the founders are typically people who've lived through this consumer wave,
Yeah.
have encountered problems building those consumer companies, and then they go out to solve those problems, which end up being B2B enterprise. So in the US, we started to see the shift around, I would say, 2019, right? Of maybe it flipped from over 50% B2B. In a place like Brazil, right? And maybe it was a little bit later. It was maybe, around 21,
Also with
22.
the launch
But
of Pix, I would say.
yeah, and also, with the saturation of local neobanks. I mean, the definitive winner is Nubank, but then you have, I would say a short tail, right, of like 3 or 4 neobanks that are also very large in their own right, that have followed Nubank, and then for any newcomer, it just becomes very, very tough, right? And hence, founders start discovering opportunities in B2B.
Yeah, no, that's really interesting. And I would say that kind of um, wide approach to the globe, not just focusing on, like, for example, the US market, or just focusing on Europe, but having that kind of global approach to fintech. It really helped out during the way to discover new opportunities and very good opportunities over time. So how do you think about those kind of things? So you clearly focused on a global approach. How do you see, the kind of division between being very vertical in a specific market or in a specific geography, or being more agnostic and more wide, I would say?
Yeah, it's a very important point. When we are investing in a place, let's go back to Brazil, right? We are never investing alone. And what that means is we're always collaborating and co-investing with local investors,
Okay.
right? And that helps kind of solve a lot of potential issues ahead of time, right? You don't want to be the sucker in the room. You don't want to be the investor that the founder talks to after the entire local market has passed for a red flag that was preventable. Maybe
Yeah.
they passed because they didn't believe in it, but there's actually a good opportunity. That happens often. But if that founder has something in their background that you should know and you don't find out, that's a problem.
That's a
One of the
problem. Yeah.
best ways to find out is to work with the local market. So when we started building Gilgamesh Ventures, we traveled to all these places and not only met the local ecosystem, but recruited some of them as investors in us, right? As
Yeah.
limited partners. Also, some of them join us as advisors, right? And I'm talking about local investors, but also local founders. In some cases, the most relevant founders became our LPs, right? And so you start building your network, and you do it heavily referral based, right? And then once you have a network of local founders that you have backed, that kind of feeds off itself. Like just yesterday, one of our best founders just sent us an opportunity of one of their friends who's starting to build a company. They're very early. They've barely talked to anyone, including the local funds. But we're seeing it because we've already invested in this country, and we've worked with funds. So it's not overnight. And also you have to nurture this, just like any relationship, right? You have to be visiting the markets that are most important to you, right? So you have to be okay with jumping on a plane often.
Yeah, I mean, this is a common trait, I would say, in this industry. I mean, we are always with our bag in the hand, you know. But no, I totally agree with a lot of things with a lot of the things that you just said. And I also noticed a trend more recently, speaking with a couple of VC out there. Everyone is trying to be very, very early and jump in as soon as they can. Maybe some time to time also before the startup went out or before they join an important acceleration program. Like, for example, I was talking with a VC that is very present in the US, and they're trying to speak with founders before they get into Y Combinator. And that was one of their major theses. You know, they want to be present, they want to be in with those kind of company that they are sure they will be able to raise money overall over time. And that is a huge trend that, in my opinion, is supported by the kind of rate of return that you have from those kind of companies. You know, being so early, being so important, and being so supportive, it means that you're going to be at the table when they will be able to raise a lot of money. And that's, of course, the kind of stage that we want to be present in.
Yeah, of course, that's the ideal scenario, right?
Yeah.
You've known someone for a couple of years, and all of a sudden they call you because they're thinking of building something.
Yeah.
And then 10 years later, they IPO and you were there at the beginning. It's not always possible, but it's certainly something we all aspire to. I mean, on our end, as I mentioned at the beginning, we are a fintech focused fund. I also have a fintech focused podcast and newsletter, right? Fintech leaders. And so all day, every day, I'm meeting with people in fintech, and I've already, and same for my co-founder Andrew. He built a fintech company himself, a very large one here in New York City. So he's been in fintech for over a decade, and so start with that, right? We live and breathe fintech. Most of the people we hang out with are building in fintech. You go to my birthday, kind of looks like a fintech happy hour, you know.
That's so, one of the party that you cannot miss in New York City.
Yeah. You know? And so what I'm trying to say here is when you do that, it compounds, right? And so I believe this is not an exact number, but it's close to 80% of the fintech, of the pre-seed companies we have backed, meaning we invested when it was just a pitch deck. We knew them already for at least 6 months before they even announced to the world, or maybe before they even were personally convinced that they were going to go out and build something. But we had met them at a dinner. We had met them at a random lunch with a maybe bigger group, or we had become friends. I mean, that happens also, right? And so that's ideal, because when they go out to raise, you've already known this person for a while. You've had deep conversations with them. You've seen them interact with other people. You've heard about their capacity to execute, and you can make a much quicker decision, right?
You also have the opportunity, to understand the person behind the founder. That, in my opinion, is very, very important. But you mentioned your newsletter and your podcast that I'm obviously following. But something, a very important question came to my mind. How important do you think it was, your content creation side to your work as a VC? There's a huge trend going on right now of people that started one of the two way that, jump on the other after time. So I wanted to understand how important it was for you.
Yeah, it's very important. That's the short answer. It's very hard for me to untangle the venture capital side from the content creation because in my case, they've always overlapped, right? I angel invested before and I didn't have content creation. I was in a banking job where you couldn't even publish on Facebook, right? So I went from that to being very public with thought leadership and content creation, and they're impossible to untangle. It's been very important. My co-founder, he doesn't have podcasts, but he brings different type of experience, more founder empathy and the kind of the understanding of how to build a company. So we also have that within the fund. But just to give you a couple stats, about a third of the companies, maybe actually close to 40% of the companies we have backed in our portfolio were influenced by the content creation. And could be a combination of I met the founder because they reached out to me after listening to a podcast, or some guest alerted me, say like, hey, someone from my company starting a startup, you should meet them, or some other combination of that, or maybe what happened a couple times. I published an interview on LinkedIn or Twitter or whatever, and I saw that someone interesting liked it. I was like, this guy says that they're building a stealth company. Let me reach out.
See what it is. Yeah.
And then we invest, right? And I have one right now that I reached out yesterday. The person responded, so we're gonna talk in a few days. So we'll see what happens. But so it's never ending, right? But the podcast has influenced that. And there's the other side. About 30, close to 30 of my guests have become LPs in the fund. And that's, from small checks to large checks. But it's been very organic, right? They come on the show and then they start asking me, what are you doing outside of the show? And then it results in them joining either as an advisor or as an investor. And finally, I've also had audience listeners reach out interested in investing, right? And so there's just a bunch of positive externalities that have occurred. But I'll tell you one thing, you really gotta like it and be passionate about it, because you know this, Michele, it's a lot of work, right? Yeah. And imagine sustaining that kind of work for not just months, but multiple years. I've been podcasting officially for 5 years. And out of those 5 years, I think I've only missed maybe 5 weeks total, right? So it's but I can only sustain something like that long if I genuinely enjoy it, right? Yeah. And if you do, it's addictive, right? There's a well-known stat amongst content creators and specifically podcasters. Most podcasts, 90% of podcasts don't make it past one episode. All right. So, So what that means is that if you make it past one episode, you're in the top 10%. Out of that 10%, I think only 10% go past 20 episodes. And so what I'm telling you is that if you go past 20 episodes, you're in the top 1%, right?
Yeah, it's that compounding effect that we have been always talking about. It needs, you need to be very, very consistent. You need to be very regular. But I would say that at the base of everything, there is the passion for what you're doing. Otherwise, you will not last. And that is the, let's say, the same concept for every kind of work out there. Otherwise, you cannot last doing the same thing for multiple years, 20 years in a row. So the passion needs to be there, or at least a little bit of interest need to be there in order to go on. But yeah, I strongly feel about that one, to be honest. But let's get back a little bit to Gilgamesh Venture. You said you raised the first fund 3-4 years ago, approximately 10 millions. I wanted to understand how hard it was when you actually did that, but most importantly, how hard do you think it could be to do the same thing right now in this kind of environment, with interest rates up, with the kind of competition that there is out there? So I would love for you to make a comparison between when you did that and the present time.
Yeah. I mean, I've done it in both, so I can
Yeah.
tell you from firsthand experience, it's never easy. That's something to keep in mind. It's never easy, but there are times where it's much harder, and there are times where it's just hard.
Yeah.
I think where we are today. So in 2021, there was a lot of momentum in the market. Everyone thought that they were missing out, so they wanted any vehicle to participate, and so I think we raised the first 2 million through personal contacts that were like former colleagues, people we had met along the way, people that had invested with us before in small SPVs, small investment vehicles we had done. So that was the first couple million. After that, it was just referral based, right? So concentric circles, you start with the core and then you keep expanding. And that included, referrals from those who had invested in you, referrals from those who were passing, but, still thought highly of us,
Word of
right?
mouth, basically.
Yeah, exactly. And so it took us about a year to raise the first fund. And then a couple years later, you go out again and you find out that the market has changed completely, right? You find out that most individual investors were tapped out, right? Or they were locked in other investments that were not liquid. So even if they wanted to invest in you, they couldn't, right? And so in general, the market today is brutal for emerging managers specifically. It's brutal for everyone. But if you look at the stats, there's never been a worse market for emerging managers to go out and raise, especially their first fund. And so the second fund is still extremely hard. I would say a couple percentages less hard than the first one. But these are published stats that you might have seen. 50% of dollars that were raised last year went to just, I believe, about a dozen firms.
Yeah, I think it was
Right?
9 or 10 VC in total.
Yeah,
And I would
yeah,
say that 90% of them were in the United States anyway.
yeah. And then you go, there's like a strong Pareto principle that has occurred, and that's because professional allocators are chasing just the safe bets, right?
Yeah.
Which doesn't mean it's going to be the best investment, right? It could
Maybe
be
it's just the
some.
best brand from time to time.
Yeah, exactly. Some of them will be amazing.
Yeah.
That's no doubt. But there's no way that only the top 10 firms are going to be responsible for good returns in VC. There's
Yeah.
just no way, right? And so that's what's been happening. And as an emerging manager, to raise your second fund, you have to really demonstrate a strong edge. You have to demonstrate that your first fund was successful.
Yeah.
No emerging manager is going to have realizations on their second or third year, or at least no meaningful ones. Maybe crypto tokens excluded. But even that, and so it's very tough, right? So one thing we did, for example, is we started tracking very closely the revenue growth of our portfolio, of our Fund One portfolio. And once you start tracking things like that, the revenue growth, margin improvements, who has invested in their follow-on rounds, things like that, you can start painting a picture. It's like, hey, we haven't had liquidity, but here's some evidence that we are not wasting our time. Here's some evidence that the companies in our portfolio are achieving meaningful growth, right? And so that's one thing we did. Then you just have to show the market that you're differentiated, right? Obviously, the podcast helps. Our background as fintech specialists helps, but it's everything, and you still have to hustle.
I think you need to have it all, to be honest.
Yeah.
You cannot just have one of them. And my opinion, in the first fund at least, there's a lot of hope or at least trust in the GP itself, in the founder that is actually launching the fund. But then when it comes to the second fund, you need to prove that you can return the money. There's no other way out, in my opinion. If you have the number to demonstrate rate of return, then you are in a good position. Otherwise, everything is going to be pretty hard, because it's a matter of returning money to the investors in the end. So there's no other mean to this kind of game. At the end, you can push for innovation. You could potentially want to bring innovation to the market, or to push for new things. But in the end, you need to return money to investors. So that's the only thing, the real differentiation, And coming to that kind of topic, we have been talking about fintech a lot. Where do you see the market right now? Because we are coming from basically 2 bad years, I would say, in fintechs, with the downturn and everything, in terms of valuation, in terms of new rounds, in terms of everything. So 2022 and 2023 were very tough years in this industry. I would like your opinion and your take, let's say, on the current status of the market, and also where do you see the market going on from now? So which are the main expectations for you going on? Which are the main trends that you are following? So how is the status, the health of the fintech market?
Depends where you look, That's the honest
That's
answer.
a good question. That's a good answer.
Yeah, but in our experience, companies that can demonstrate either product market fit, but also growth and strong, healthy numbers, they're getting things done. We're seeing a bunch of our companies in our portfolio right now that they went out to raise, and they're getting interest, right? I think in the next couple of months, we're going to see quite a few closings. We've already seen a few in the last couple of months. We're going to see a couple more of follow-on rounds, right? And with healthy markups, right? So, but it's not everyone, right? So the market is, I would say, I don't know, I don't want to call it healthy, because I don't know exactly what that means, but if for serious companies that have managed to get their numbers under control and they're showing growth that is either organic or healthy growth, not just pumping numbers with horrible unit economics, they're actually getting deals done, right? So there's plenty of investors out there. There is a desire, there's a lot of interest to back the strong companies, but if you don't have some evidence that you're not going to be able to raise your second round. I think another way to say it is, investors are willing to give founders one shot when it comes to selling the dream, when it comes to raising on no traction, right? But once you raise that round, the next one, you gotta come back with some evidence, right? And so the case before was, you can come back again and get some more fuel to continue running experiments and with no evidence. But that's
Chase the
gone,
dream, let's
right?
say.
Yeah, so that's long gone, right? So now, which leads me to kind of my advice for founders is your first round should not be too small, right? Because you should raise enough to be able
Demonstrate,
to
maybe.
demonstrate some evidence that you have found something meaningful if you want to raise again. If you think you can only raise one time and never raise again, okay, raise whatever you want. But if you think you're going to come back for a second or third round, make sure you raise enough to come back with something later, because even your own investors will be suspicious of doing a bridge with no evidence. It'll be a bridge to nowhere, right?
Yeah.
So that's definitely a change. But overall, I mean, we're seeing Series A's get done. We're seeing Series B's, even Series C's and D's. They're happening, right? But it's just for much healthier companies. You do have some cases where you meet this extraordinary founder that is just so magnetic, and they can overcome some of their metrics, but that is just reserved for like, yeah, exactly the 1%.
Yeah. No, I totally agree. I strongly believe that one of the reasons why we had, those kind of bad years, couple of reasons mostly, was because we were coming from a period of time where basically valuation were totally crazy, and we went way higher with what we should have done. And on the other side, we had basically zero liquidity events in 2 years. No one got acquired, no one got an IPO. That was one of the main problems. I think that 2025 would potentially be the year of liquidity events, and we could potentially have more cash on the market, more liquidity, more capital that could bring, back a little bit of liquidity into the market and also in the hands of the founders.
Yeah, that's what we are all hoping for. And there are a few fintech companies working actively on their IPO plans right now. There's obviously a few that have publicly announced. That's Chime, that's Klarna, a couple more. But I've said this before, but I was talking to a very, very senior investment banker, and apparently the number of tech companies that have confidentially filed for an IPO is in the 100 to 200, right? We just don't know about them. Some of them have leaked. And now they're not all filing because they want to go public. Some of them are filing because this is a way to tell the market, you're looking for something else, maybe an M&A or something. But many of them will, and they're gonna keep that in confidential filing they can keep it indefinitely, but probably for a year or two, just to be IPO ready and go out when the time comes. But we'll see. I mean, people said last year was going to be the comeback of the IPO market. That didn't happen. I have more hopes for this year, but I'm also not holding my breath.
No, I agree. I think that there are good signals out there for a good year and for a year with good liquidity events. Mostly the one announced, But overall, I think that this is something that the industry overall needs in order to start sprinting again. But more specifically, let's say to the kind of trends that you're seeing in the market. So recently, I'm talking with a lot of VC managers and GPs and everything that are looking for specific trends in this industry. One of my top, for example, prediction for 2025 in terms of trend was stablecoin in payments. So I wanted to have your take on those kind of, let's say, more specific segments. So which are the main ones that you are currently taking a look at, and which are your top prediction for this market in 2025?
Yeah, it's probably two. one is related to stable coins,
Mm,
but it's not just stable coins. I
mm,
think global B2B payments
mm,
is gonna see a lot of innovation.
mhm.
It's already happening, and I
Yeah.
see it with the founders I talk to. Stable coins are part of that, right?
Mm,
But there are many other ways to disrupt that market. It's about 10 times larger than remittances.
mhm.
So, and
Yeah.
the margins are in some cases insane. So that's a market where we're paying a lot of attention. And then the other one is all things compliance and anti-fraud, right?
Mm,
We have made a couple investments in that space, but it's so big and there's so many ways to attack it that I think we're going to see more, and that's not just compliance for banks, but compliance for financial institutions, compliance for any Fortune 500 corporation, right? These are operations that in most cases are very manual. And so we're seeing more tools to automate this, obviously fueled by the new wave of AI. And so those two areas, no doubt, they're only going to become bigger over the next 12
yeah.
months.
Yeah, coming from the fintech industry, I can only feel about the kind of pain that is, making compliance, making fraud check, and all of those kind of things. That 90% of the cases are manual. In the 10% of the cases that they are not manual. They are still very, very painful, and they take a lot of time. They take a lot of effort. They have a lot of errors. So I would say that fraud prevention and compliance check are a very big topic going on. We also saw, for example, recently WorldPay acquiring a company in that space that was, if I remember correctly, Reveling Technologies that is doing fraud prevention, and is obviously very interesting. But yeah, I agree overall. One of the most interesting trends, coming also to what you just said, B2B payments is, in my opinion, very interesting. I will also add, under that point of view, not just B2B payments, but also B2B cross-border payments. This is one of the topic that for example, I've invested in a startup that is trying to do that in Italy with cryptocurrencies. And we find out, for example, that in order to receive a bank transfer from outside the European Union, there are certain kind of companies that are waiting 20, 25 days. That is a huge amount of time that is impacting your cash flow, that is impacting everything on your side as an entrepreneur. And there's huge space for innovation in that kind of area. Mostly with those kind of countries, like, for example, Italy, but also like, for example, the US, that are doing a lot of import-export, that has huge commercial balances. And I think that is one of the area where I expect at least most of the innovation coming in terms of reducing time and in terms of reducing fees that are still very, very high. So that is one of the topics that I mostly take a look at. But let's come back to your role as an investor. I would love to understand, what are you looking for in a founder when you actually deciding to invest in them? So which are the main characteristics of a founder for you to be very sure about them?
Yeah, and by the way, Mika, I have to run, but let's do this question, then we'll wrap up.
Yeah.
Um, yeah, I mean, it's all about the founder. That
Mm,
that's the truth, especially when you're investing early. Now, that being said, we're not at the point where we invest in a founder before they have an idea. We're just not comfortable with that. Um, but we are comfortable with a founder that has an idea, has a
mhm,
plan, goes out and tackles it, and then the idea changes a little bit, right? But
mm,
for us, we 80% of our investments, they are in fintech insiders, people
mm,
that have worked in the space one way or another. It doesn't have to be in a fintech, but in the industry, and they understand where the problem lies, and they also know who are the customers, and they know who do
mm,
they have to partner with. It's such a powerful thing to be an insider. Now, and there's also 20% of people who are outsiders, and they will things into existence. But the number one thing is this founder extraordinary, right? Do I see myself working for them, right? That's very important. And hopefully you have a high bar for that. And number two and three is, this is not surprising, but how big is your market? You can never grow a company that's bigger than your market, which is why most VC activity is concentrated in very large markets, countries
Yeah.
with large populations. And then you got to have an understanding of the product. And
Yeah.
this is where being an insider gives you an advantage, right? I know, or I can find out if a potential customer really needs this or not.
A knowledge, let's say, advantage, I would say.
Yes.
Great. Miguel, it was a real pleasure to have you here. It was a great conversation. To be honest, I could go on for hours, but I know that you need to run. So thank you again for joining. It was a pleasure, and I wish you all the best on your future investments.
Thank you, Michele. Grazie mille.
Thank you. Bye bye.